This is the WealthNet Market Call of the Week, highlighting investment trends that could affect your wealth. Globally aware with a geopolitical and quantitative perspective.
Hello, this is Louis Llanes with WealthNet Investments, and this is the Market Call of the Week. Today I'm going to be talking about risk management. You know, risk management is probably one of the most important things. In fact, I know it's the most important thing when it comes to managing money. So I'm sitting here at my home office with my dog who's lapping up a bunch of water, and just got back from Texas and hit the ground running here at the office. And as you may know, and you're probably aware of, last week we had quite a sell-off in the stock market. And I was looking through the daily return patterns for our strategies, and basically what we saw was increased volatility. That increased volatility, of course, was to be expected when the markets increase their volatility. It just became clear to me that a lot of people are not really getting a clear grasp of their risk control. And it made me think about a book I read a while back called Trading Risk: Enhanced Profitability Through Risk Control. It's by a gentleman by the name of Kenneth L. Grant. I highly recommend reading this book. And one of the things I want to talk about is just some of the basic general guidelines that are outlined in this book, because I think they're really universal. And I don't care what kind of trading, strategy you have, and what it really, how you construct your portfolios. Risk control is very, very, very important. And, when I was looking, before I dive into these, I wanted to just talk a little bit about what I learned going back in and just looking at this year. What I did was I looked at this year's performance in my proprietary account day by day for the whole year in detail. And I looked at what were some of the best things I did and some of the worst things I did this year. And I think just going through and looking at that in time, it helps you really say, okay, how can I improve what I do? And that's the whole really point of having risk controls and monitoring. I'm a member of an organization called Strategic Coach, and one of the tools that we use in Strategic Coach is something called an experience transformer. What an experience transformer does is it basically helps you think about a bad experience or a good experience that you had, and really isolate down what worked in that experience, what didn't work, and knowing what you know now, what you would change. And then from there, you can actually institute policies on a go-forward basis. Now, I found this to be really an invaluable thinking tool, and I'm applying that to risk control. If you look at your performance on a day-by-day basis, it's amazing what you'll find. You'll find when you're increasing the volatility of your portfolio, when you're decreasing the volatility of your portfolio. You'll find out which one of those picks were working well, which one of those picks were not working well, and what you could have done ahead of time to avoid some pain, and what you could have done to capitalize more on your winners. So I'm going to talk a little bit about some of my notes and just kind of going through this philosophy of risk control. The first thing is you want to have a profit and loss of your time series, or I should say a time series profit and loss statement. You want to be able to see your P&L in time series, and preferably day by day, and then rolling it up to week by week, then the quarter, month, then quarter, then year. And when you look at it on over various time frames, you can actually see your results much better. So it's getting that time series of your profitability. And of course, you want to look at your returns themselves, the volatility of the instruments that you are trading or investing in, and the correlations and how they've interacted with each other over that time frame. And looking at those parameters helps you get a clearer picture about how you're doing. And it's really good to see those on a periodic basis as you're going along, just to check to make sure that you're actually getting your objectives, because that's something that you really have to come up with, is what are those predefined objectives that you have? What is it? What is the objective that you're clearly trying to establish? And there's three main types of objectives that really portfolio strategists should have. The first would be kind of your notional requirement of return. So what is that return that you're looking to get as a minimum? Like, you should be able to achieve this objective. Even though you don't have control over the markets, you have a lot of control over your position sizings, what you pick, and your adjustments that you can make along the way. And it's really good looking at the environment, saying, what is the environment going to give me? Like, for example, right now the earnings yield is somewhere around 5% on the stock market, and 10 years trading at around 3%. So, given your allocations and what you're looking for, what is that kind of nominal return that you expect that you should be able to hit? And, it's how you construct your portfolio is really important. That's a whole nother topic. And then the second thing you want to look at is, what is your optimal return? Like, what if everything is just right, like all conditions are right for how you invest, how you trade, what is that optimal return that you can hit? And you're really trying to shoot for that because you really want to reach for a higher number than your nominal return. And then you need kind of a stop number, like over a given time frame, whatever that may be, monthly, quarterly, annually. What is that level of maximum risk that you're willing to accept over that time horizon? Very, very critical and very crucial. So establishing those objectives, and then you really want to look for, how are you going to execute? You really have to fight for great execution because trades have to be done in a timely manner, and they need to be done when you need them to be done, and you need to get good pricing. And that's really important because all of these things that you do at the margin really determine how well you're going to do. So, if you get an extra a cent between the bid and the ask, if you are able to get better execution, if you pay less in commissions and slippage, if you trade instruments that are not going to slip you too hard, all of those things make a difference. Now, the other thing we want to look at is, what are those predetermined levels we talked about? What is your targets and your stop levels? Are you going to have on every single opportunity that you're looking at? When you're looking at an opportunity, if you're not really assessing the reward risk opportunity before you place your hard-earned capital, it's very difficult for you to position size. It's one of the things that you have to know. So reward risk ratio. Also, what are those trading parameters that you need to adhere to? What is the daily volatility that you need to see? What is, in order for you to achieve your objectives? And, what is too high of a volatility? You don't want to get caught when your risk parameters are not being controlled. And that's one of the biggest lessons in risk control, is that if you don't control your risk, if you get outside of your risk parameters, you have an excuse why you should get outside your risk tolerance. Maybe it works for you 1 time, 2 times, 3 times, but eventually everybody gets caught. And if you get caught beyond your risk profile, it's very difficult to make it up from there. So not getting out of your risk profile is really important. And then, the next thing would be comparing your decision-making criteria during periods of strong performance versus weak performance. So if whatever instruments that you're trading, when the environment is great and in your favor, how was your decision-making during that period of time in your period that you're looking at? And how was your decision-making when you had a weak period of time? And ideally, what you want to be doing is you want to be increasing your volatility to some extent. You don't want to have too much volatility, expansion and contraction, but you want to be able to capitalize when the conditions are right. And then when the conditions are not right, you should be pulling back a little bit on your risk. And there's a lot of little tricks with that, but being able to compare your decision-making criteria during those periods of good and bad times really makes a difference. So you always want to have a little bit of risk budget set aside for innovation. You want to try new things because the market is always changing. Because the market is changing, you want to take some of your risk and you want to be able to set it aside and say, I'm going to use this to innovate. And you want to make it to where it doesn't cost you. So maybe when you're having a good period, you take a little bit of your risk capital that you normally would have put into your process, and then you say, I'm going to reserve this risk budget for innovation, new strategies. Reducing your exposures when the P&L is down and increasing exposure when your P&L is up. That's one of the critical things that many traders have. Recently Stan Druckenmiller had a interview on Real Vision TV, and he said, one of the most critical, important things that I need to do, and this is a gentleman who has had pretty impressive returns by any standard. Compare him against anybody you want to, Warren Buffett's of the world, and his record's up there. What I would say, and one of the things he said is, my most critical thing that I need to do is I need to know when I can see the ball and when I can't see the ball. And when I'm not seeing the ball, I need to reduce my exposure. If I'm not clear on what I'm doing, I need to reduce my exposure. And when I'm seeing the ball well, I can increase my exposure. Very important point. Reserving risk capital for unique opportunities is another super important thing, because every now and then there's something really unique that happens, and you really want to be able to have some dry powder so that you can actually use that risk budget to take advantage of it. One of the things that happens a lot of times, and this happens to most investors and traders, is when they actually see the opportunity that's really blaring and is staring them in the face, they don't have the risk capital to use it because they're in a drawdown, in performance. So having that extra set aside risk is super, super important. You keep a portion of your profits so that you can redeploy it. You might trade smaller when you're not doing so well. You might cut trades sooner, and you don't want to press your bets at the wrong time. Probably the biggest thing that hurts performance is when you start pressing bets because you get overconfident at the wrong time. I've had this in my performance. I think everybody has had it in their performance. And this is something that happened. I believe this is happening right now in the marketplace. More and more people are pressing their bets because it's been easy. There's been a strong stock bull market, and people are pressing their bets, and they're outside of the risk parameters in many cases. Not everybody. I know this is a generalization, but it is something that what I'm seeing, boots on the ground. We meet with individual investors and we talk with them, and they come with us with significant seven-figure portfolios, and we see what's happening out there. That is what's happening. So another thing you want to look at, and this is the thing about risk control that's so important, is you have to take enough risk to meet your goal. If you're not taking enough risk, what's going to happen? You're going to wind up underperforming. By default, you'll underperform. Even if you hit everything right, there's not enough volatility in your portfolio for you to actually hit your number. You got to take enough risk too. Making improvements at the margin. And I talked a little bit about this, but this is super important. What is your execution? How are you getting that done? Are you using VWAP, for example, trying to be below VWAP? How are you trying to get better execution? Lowering those commission costs, your risk management, more precise risk management and sizing, and better research. Those are the four big things that all compound. It's like stacking dimes upon dimes. They compound up. So there's a profit and loss cycle. It can be up, it can be down. You need to know where you are and trade accordingly. So another thing is to not rely so much on participants to comfort you. A lot of people I know who are professionals, they listen to other research firms and et cetera, and there's nothing wrong with that. But I do find that it's almost used as a drug. It's kind of like a soothing drug to hear some other analyst or some other research outfit telling you what you want to hear and talking up your book. That's not what you want. What you really want is you want to have seeking the truth being your ultimate goal. I was thinking about Ray Dalio. Ray Dalio has a whole process in his firm that deals with seeking truth, and that means seeking truth with people, how people have strengths and weaknesses and what they are, and being realistic about them and really moving forward based on that. So these are just some things I wanted to talk about. Setting performance objectives at optimal target, nominal target. To summarize there, you want to have that. You want to know, what is that minimum target? What is that like? If everything's on full cylinders, what am I trying to do? How much volatility am I going to take? Understand your Sharpe ratio. This is something that I think people, they overestimate. They might backtest the solution and they see a Sharpe ratio that's 1-to-1, where the return is about the same as the risk or the annualized standard deviation. And those are very, very difficult to actually achieve over the long run with a positive skew or even a flat skew. Generally, when you do see tests like that, there'll be negative skew type performance records, and those generally have some bigger risk embedded in them. What is that stop out level? What is that final decision that you're looking at, that you're trying to get to for your targets? And just really going by it, and I'm looking at right now, I'm just kind of going through and looking at my day-by-day record, and I see both good and bad. Early in the year, very successfully hedged out market risks, which really helped in the first half of the year. And then as we came down, I added a little bit more opportunistic character to the portfolios. That helped. Overall, my volatility for clients and for us, for my personal prop account, has been lower than the S&P 500, significantly lower. There was some times where I added risk at the wrong time, where that hurt overall. So, it wasn't perfect, and there was some great learning in this process. So I'm bringing this up. Maybe you get an idea from it if you are a portfolio manager or a trader, and maybe you dive in a little bit more in your own risk management. So again, this is Louis Llanes with WealthNet Investments. If you like this information, if you'd like to learn more about what we're doing, feel free to go to our website at wealthnetinvest.com. Look me up on Twitter and subscribe to YouTube. We'll be having a lot more stuff coming out and website redevelopments that are coming out. So keep an eye on what's going on. Again, Louis Llanes with WealthNet Investments. Happy investing and trading.
If you like this information, be sure to subscribe and follow us on Twitter and Facebook. The market calls are designed for informational purposes and should not be considered investment advice. As always, do your homework, assess the risk, and invest in light of your personal goals.